Welcome to this explainer. So, you've got this amazing, scalable product in a totally validated market. You're ready to go, but right out of the gate, you hit a wall. There's this one universal bottleneck standing between your great idea and a thriving company. And yep, you guessed it, it's capital. Honestly, every successful business eventually needs external funding just to survive and grow.
Okay, let's dive into this. If you're gearing up for your very first funding round, you're looking at a real paradox. How do you convince cautious banks and, frankly, skeptical investors to trust a completely unproven venture with their hard-earned capital? Well, today, we are breaking down a step-by-step guide for entrepreneurs looking to secure that crucial first round of funding.
Here's our roadmap for today's journey. 1. Why businesses need money. 2. The limits of bootstrapping. 3. Repayment capacity. 4. Bank loans and collateral. 5. Modern funding options. And finally, 6. Choosing the right financing. Let's start with Section 1, why businesses need money. Before you turn a single dollar a profit, you got to spend money, right? Equipment, payroll, marketing, it adds up fast. And these needs generally fall into 3 distinct buckets. First, you have startup capital. This is literally just the cash you need to turn the lights on. Then there's working capital to cover your everyday operational burn. And finally, expansion capital when you're ready to scale up. You know, misidentifying which of these buckets you're actually trying to fill is one of the absolute biggest reasons pitch meetings fail.
Moving right along to Section 2, the limits of bootstrapping.
Look, self-funding is the default starting line for most of us, and the upside is absolutely undeniable. You have complete autonomy. You have no investors dictating terms to you, no stressful monthly loan payments, and zero interest eating away at your margins. Sounds great, but the downside? It's a terrifying lack of a safety net. If the business goes under, your personal savings completely vaporize with it. It's a really high-stakes balancing act.
Which brings us to Section 3, repayment capacity.
Eventually, those personal funds are going to dry up, and outside financing just becomes necessary. But before any lender actually opens up their checkbook for you, you have to survive the ultimate gatekeeper question. Can this business actually pay the money back?
And that all boils down to repayment capacity. Basically, are you generating enough surplus cash to service new debt? I mean, after you pay payroll, rent, utilities, and taxes, is there actual, real margin left over? Startups don't usually fail because the founders lacked vision. They fail because they simply can't mathematically prove to lenders that their daily operations throw off enough cash to make a monthly loan payment.
Let's look at the traditional route in Section 4, bank loans and collateral.
When you walk into a bank, do yourself a favor and leave the grand visionary pitch at the door. Banks trade in risk, and they evaluate it using cold, hard numbers. So how do you actually prepare this financial documentation? Well, you can't just hand over a shoebox full of crumpled receipts. You need to officially separate your personal and business accounts immediately. You need to use standardized accounting software to generate crystal-clear profit and loss statements. And you have to run realistic, data-backed cash flow projections. They just want documented proof you can survive. Remember, they aren't buying your company. They just want their money back, plus interest.
Now, even with totally perfect paperwork, banks still want a safety net, and that's your collateral. This is the property, the vehicles, or the equipment they can legally seize if you default. But here's a really surprising fact. Banks actually vastly prefer repayment capacity over collateral. Why? Because banks are in the business of collecting steady interest. They really don't want to become a second-hand dealer for your used pizza ovens and office chairs.
Let's broaden our horizons in Section 5, modern funding options.
If a traditional bank just isn't the right fit for your model, don't worry. The modern financial ecosystem totally has you covered. Today's founders can tap into a huge variety of sources: angel investors, venture capital firms, crowdfunding, government grants, peer-to-peer lending, or even strategic partnerships. And every single one of these is a specific tool with its own unique cost of capital.
When you're navigating all these options, it almost always comes down to one massive trade-off: debt versus equity. Equity means bringing in investors. Now, you don't have monthly loan payments draining your cash, which is great, but you are giving away permanent ownership, a slice of your dream. Debt, on the other hand, means taking out loans. You keep 100% control of your company, but you are absolutely on the hook for rigid monthly payments, even if the market completely downturns. Honestly, choosing between debt and equity depends entirely on your personal risk tolerance and how fast you want to grow.
Finally, let's wrap up with Section 6, choosing the right financing.
Smart founders know they have to strategically match their financing method to the exact lifespan of their need. For example, short-term needs, like bridging a quick seasonal inventory gap, should absolutely be funded with short-term credit. Conversely, long-term investments, like building a massive manufacturing facility, demand long-term funding. Trying to fund a 10-year factory build using a 12-month loan, that is a classic company-killing mistake.
Ultimately, your entire financial strategy just comes down to balance. Choking your business with way too much debt, that creates catastrophic risk. But on the flip side, operating out of fear and taking on too little capital, that starves your growth and essentially just hands your market share right over to your competitors. Capital is a tool, and it requires real precision, not just sheer volume.
I want to leave you with this really powerful thought from our sources today. Money isn't just fuel. It's the bridge between an idea and a successful company. You could have the greatest blueprint in the entire world, but if you don't secure the right materials, that bridge is going to collapse. So take a hard look at your own venture. Are you building a bridge that can actually carry the weight of your ambition, or are you just sketching blueprints? Thank you so much for joining me in this explainer. Keep learning and keep building.